Exchanges in the US are the New York Stock Exchange (NYSE) and the Nasdaq, where thousands of publicly traded companies list their shares. To start investing, beginners typically open a brokerage account through platforms like Fidelity, Charles Schwab, Robinhood, or E-Trade, which act as intermediaries that allow individuals to trade stocks. One of the first concepts to understand is the difference between stocks and other investment types. Stocks represent equity, while bonds are loans to companies or governments, and mutual funds or exchange-traded funds (ETFs) are collections of various assets bundled together. ETFs are especially popular for beginners because they offer diversification, meaning your money is spread across many companies instead of relying on the performance of a single stock, reducing risk. Another important principle is supply and demand, which drives stock prices. When more people want to buy a stock than sell it, the price goes up, and when more want to sell than buy, the price falls. Market movements are influenced by factors such as company earnings reports, economic data, interest rates set by the Federal Reserve, geopolitical events, and overall investor sentiment. Beginners should also learn about market indexes like the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite, which track the performance of groups of stocks and provide a snapshot of the overall market's health. The S&P 500, for instance, includes 500 of the largest U.S. companies and is widely considered a benchmark for the U.S. stock market. A key strategy for new investors is long-term investing, often referred to as buy and hold, which involves purchasing stocks or funds and holding them for years or even decades, allowing compound growth to work in your favor. Compounding occurs when your investment earnings generate additional earnings over time, significantly increasing your total returns. Risk tolerance is another essential factor to consider, as stock prices can be volatile in the short term, meaning they can rise and fall rapidly, so investors must be comfortable with potential losses and avoid panic selling during market downturns. Diversification, mentioned earlier, is one of the best ways to manage risk, as it ensures that poor performance in one investment does not drastically impact your entire portfolio. Beginners should also be aware of the importance of asset allocation, which is the mix of different types of investments in your portfolio, such as stocks, bonds, and cash, tailored to your financial goals, age, and risk tolerance. For example, younger investors may allocate more to stocks because they have a longer time horizon to recover from market fluctuations, while older investors may prefer a more conservative approach. Another foundational concept is understanding different types of orders when buying or selling stocks. A market order executes immediately at the current price, while a limit order allows you to specify the price at which you want to buy or sell, giving you more control. It is also important to pay attention to fees, such as trading commissions or expense ratios for funds, although many modern brokerages offer commission-free trading for stocks and ETFs. Taxes are another consideration in the U.S., as profits from selling stocks may be subject to capital gains tax, with different rates depending on how long you held the investment. To minimize taxes and maximize growth, many investors use tax-advantaged accounts such as individual retirement accounts (IRAs) or employer-sponsored 401k plans, which offer benefits like tax-deferred or tax-free growth. Research and education play a crucial role in successful investing, and beginners should take time to understand the companies they invest in, including their business models, financial health, and competitive advantages. Although for those who prefer a simpler approach, index funds that track the overall market can be an effective and low-maintenance option. Emotional discipline is equally important, as fear and greed often drive poor investment decisions, such as buying high during market hype and selling low during panic. Maintaining a consistent strategy and focusing on long-term goals can help avoid these common pitfalls. Additionally, dollar-cost averaging is a useful technique for beginners, where you invest a fixed amount of money at regular intervals regardless of market conditions, reducing the impact of market volatility and removing the need to time the market. It is also helpful to set clear financial goals, whether saving for retirement, a home, or education, as this will guide your investment choices and time horizon. While the stock market offers the potential for significant returns, it is not a guaranteed way to make money quickly, and beginners should be cautious of scams, get-rich-quick schemes, or speculative trading strategies that promise unrealistic profits. Instead, focusing on steady, disciplined investing and continuous learning is more likely to lead to long-term success. In summary, the U.S. stock market provides individuals with an accessible way to build wealth by investing in businesses, but understanding basic concepts such as stocks, diversification, risk management, long-term strategies, and emotional discipline is essential for beginners to navigate it effectively and confidently.